Platform stocks in India, often referred to as digital, e-commerce or consumer technology companies, have become a significant growth theme. They leverage digital infrastructure to connect users, sellers and services. These companies typically operate on asset-light models, focusing on scalability and network effect. But their path to profitability remains a complex web and most investors fail to grasp the trajectory. Valuing the profitability and cash flow trajectory of India's modern platform businesses requires a departure from the traditional price to sales ratio. Rather, their valuations need to be in favor of granular lens focused on unit economics and cash profit margins. Much like the early days of Amazon, companies like Eternal, which is Zomato, PB Fintech and Brainbees Solutions often operate in a state of accounting loss, while their underlying business engines show signs of becoming efficient and eventually more profitable. To judge the path to profitability of these entities, an investor must first look at the unit profitability, which represents the profit made on each unit sold after accounting for direct variable costs like delivery, payment gateway fees and immediate discounts. For a company like Eternal, this means tracking the transition from losing money on every delivery to making a few rupees per order. When this margin turns positive and begins to expand, it signals that the platform has reached a scale where its core service is self-sustaining even if the corporate entity remains in the red due to massive fixed costs like technology teams and brand marketing. In the case of PB Fintech, the parent of Policy Bazaar and Paisa Bazaar, the evaluation of shift towards renewal or lending book is important. Platform businesses in the financial service space often incur high customer acquisition cost upfront to bring a user into the ecosystem. However, the true value and the cash flow lies in the lifetime value of that customer. An investor should analyze whether the cost to acquire a customer is falling relative to the commissions earned from recurring insurance renewals or additional credit products sold to the same user. If the LTV to the CAC ratio, which is the lifetime value to customer acquisition cost ratio, is improving, then the trajectory towards profitability is structurally sound. The recent pivot of PB Fintech towards net profitability in 2024 and 2025 serves as a real-world case study. Once the old cohorts of customers began renewing their policies without requiring new marketing spend, the high margin revenue flowed directly to the bottom line, quickly covering the fixed cost of the platform. For retail-centric platforms like FSN e-commerce ventures, such as Nykaa, and Brainbees Solutions, that is FirstCry, the metric of choice is often the average order value coupled with the frequency of purchase. Unlike a one-off purchase, these platforms rely on customer stickiness. If a parent of a baby returns to the FirstCry website every month for consumables like diapers, the platform's marketing efficiency shoots up because it no longer needs to buy that customer's attention through expensive Google or Meta ads. Investors should scrutinize the marketing spend as a percentage of revenue. In a healthy platform, this percentage should decline over time as organic traffic and word of mouth take over. If a company is growing revenues by 30% but its marketing spend is also growing at 30%, it is merely running on a treadmill. True profitability emerges when the revenue growth significantly outpaces the marketing and promotional expenses. This is also called as operating leverage. IndiaMart Intermesh, for instance, offers a different perspective as a B2B classifieds platform. Here the focus is almost entirely on the negative cash conversion cycle and deferred revenue. Because IndiaMart collects subscription fees from suppliers upfront for services rendered over the next year, it generates cash from operations long before the money is recognized as accounting profit in the income statement. For such businesses, the most honest metric is free cash flow. An investor who only looks at the profit and loss statement might see a modest company, but one who looks at the cash flow statement will see a cash generating machine. The cash provides a margin of safety, allowing the company to reinvest in new product categories or acquisitions without ever needing to dilute shareholder capital. Ultimately, the trajectory of these platforms is a race between operating leverage and market share. Investors must determine if the fixed cost base, the servers, the offices and the executive salaries is being spread over a large enough volume of transactions. In 2026, as several of these companies move from the hyper growth phase into the earnings delivery phase, the market has become less forgiving of the adjusted EBITDA figures that exclude real costs like employee stock option expenses. By stripping away the creative accounting and focusing on the cash generated per transaction, the sustainable winners become clear. The goal is to find the companies where the market is finally beginning to acknowledge a cash-rich foundation hidden beneath years of reported losses. Coming to valuations of the platform businesses, the era of valuing Indian platform businesses on vanity metrics is firmly in the rearview mirror. During the peak of the recent funding supercycle, investors were often content with hyper growth in gross merchandise value and escalating average order values as the primary indicators of success. This perspective assumed that scale would naturally lead to a winner-takes-it-all dominance, where profitability could be toggled at will. However, as the market matures into 2026, the disconnect between top-line growth and sustainable value has become impossible to ignore. The previous reliance on AOV as a proxy for health often masks the ballooning costs of customer acquisition and the fragility of delivery logistics, particularly in the cutthroat quick commerce and D2C sectors. Today, the investment thesis has fundamentally pivoted towards real cash earnings and the granular reality of unit economics. High order values mean little if the fulfillment costs, marketing burn, and return ratios result in a negative contribution margin. Investors are now dissecting unit economics, which account for all variable costs, including packaging, last mile delivery, and payment gateways, to determine if a platform is actually building a business or merely subsidizing a lifestyle for its users. The shift is driven by realization that capital is no longer infinite or cheap. So, companies must demonstrate a clear path to self-sustainability where every transaction adds to the bottom line rather than depleting the treasury. As interest rates and global liquidity normalize, the premium has shifted from the promise of tomorrow to the yield of today. Consequently, the platforms that command the highest valuations are no longer those with the most aggressive expansion maps. Rather, the focus is on those that have mastered operational efficiency and can convert high-velocity transactions into predictable free cash flow. This transition marks the coming of age for the Indian tech ecosystem, where the rigor of traditional fundamental analysis has finally caught up with the innovation of the digital economy. Hope you like this video. Thanks for watching.